You're about to hear my conversation with Dustin Reed, Chief Strategist of Fixed Income. Today, we'll debrief on the latest from the FOMC, Dustin's thoughts following Prime Minister Carney's trip to the White House, and what Dustin thinks looks good in the markets right now. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to the Market Exchange podcast from Mackenzie Investments. I'm Rajan Bansi, Head of Portfolio Construction and Mackenzie Private Wealth, and I'm filling in for your regular host, Matt Schnurr. As usual, our Chief Strategist for Fixed Income, Dustin Reed, is here, and we are going to get right into the questions. Dustin, thanks for joining us on the podcast.
Hey, thanks very much for having me. I'm looking forward to doing this one with you.
Me as well, and it's a very timely one. Now, Dustin, just yesterday we had the latest FOMC meeting. The headlines suggest not too much happened, but I know the truth is lots happened. Can you bring us up to date on what we learned yesterday from the Fed?
Yeah, absolutely. And I think you're exactly right. Maybe the headlines aren't that much, but there's always a lot of paddling under the surface in terms of the little nuances. So maybe to get the easy stuff out of the way, obviously the May meeting, no change in rates. The Fed still has Fed funds at 4.25 to 4.5. This is not a forecast meeting, being the May meeting, so no dot plot, no update, that sort of thing. But of course, now there's a press conference at every meeting, and we had the usual Powell press conference. The statement didn't change too much, although there was one section where I would say it changed somewhat significantly. And the takeaway, I think, not only from the statement but also from Powell's press conference later in the afternoon, was that the Fed thinks, rightly or wrongly, that the extremes are becoming exactly that, more extremes. There's a greater risk for upside inflation, and there's a greater risk for downside growth. At least that's how the Fed is seeing it. Again, obviously in between forecast updates between March and the June meetings. But Powell, during his press conference, really focused a lot, I think, a lot more on the upside risk to inflation side, which has clearly been where he has been, and it's clearly where the vast majority of participants, including the voters, have been as well. You've not seen a lot of participants talk about downside growth risks and cutting rates. Rather, a lot of the commentary is and there's a lot of upside risk to inflation, could be in a stagflationary environment, underlying economy is quite good, rates are in a very good place. A lot of that commentary, not only from Powell yesterday, but participants in between the meetings, between the March meeting and the May meeting. So I think that's where the FOMC really saw things yesterday, and it's pretty clear that unless something goes very, very wrong, very left tail, as we would say, it seems very unlikely that the Fed is going to be in a big rush to cut rates. What you would need to see for the Fed to cut rates would probably be a significant deterioration in the labor market that's relatively sudden, and that, for lack of a better term, I would say overwhelms any upside actual inflation and views that medium and long-term inflation expectations are becoming unanchored. And that seems like a pretty heavy lift at this point.
Great place to start the conversation, Dustin. I want to continue it where you left off. I'm pretty interested what we should expect from the Fed going forward. You highlighted that Fed Chair Powell had a focus on inflation. Other commentators seem to be more concerned about growth, if I look into what the market is pricing in for hopeful rate cuts by the end of the year. So you're the expert here. What should we expect from the central bank going forward?
I think the Fed still can cut this year. And I think that that's possible. But we've been kind of trending in this neighborhood. If you look at calendar 25, kind of been trading in this neighborhood of anywhere from, say, 70 to 90-ish basis points. I mean, it's been outside that range, obviously, but generally speaking, kind of central tendency, 70 to 90 basis points over most of the last handful of weeks, month and a half, 2 months. And, we're starting to see a little less easing get priced in. I think the market had an eye on June, maybe 10-ish basis points, 12 basis points, that neighborhood for a while. And then I think that we're starting to see the market give up on that. And that's probably for a few reasons. One, Doesn't have to be this way, but if the Fed was very serious about June, or even semi-serious really about June, it probably would have left the door a fair bit more open to June at this meeting, at the May meeting. Powell is clearly just not giving that signal. We only have one non-farm payroll report between now and the June meeting, and the last payroll report was relatively constructive. Whether you look at the headline rate, the headline job creation number, how much of it was private, the unemployment rate versus previous month, where the some people look at U6, which is another version of unemployment. I mean, it all looked relatively constructive. And so how much can that labor market change? I mean, obviously it could change if something very, very odd happened between now and the June meeting, but it would be effectively one meeting, or one report, I should say. And is the Fed going to make a big change on one report? So I think that that's becoming a little bit more difficult. It absolutely means that the Fed could cut later this year, and there are weak pockets of growth in the economy. But the market has generally been trading, whether you look at equities, fixed income, and kind of credit, or even FX to a point, although maybe a little more complicated than how I'm going to say it. But the market's really been trading on a growth theme, or a concern over a growth theme, and not an inflation theme. And when you've had a couple of pieces of data, particularly I'd say ISM services, was quite a bit stronger than expected, and you had another strong payroll number, it seems to suggest that the Fed's got a little bit of time in hand. And if the market has been trading on a U.S. has lost its growth exceptionalism theme, which we can have that discussion. But if the market's been trading off that theme and it's wrong, for lack of a better term, then clearly you're going to see the market kind of rebound and reprice based on how it's been trading and leaning over the past number of weeks.
I want to spend a little bit of time on tariffs, Dustin. Chair Powell's comments yesterday referred to, it's not really clear, I think, on how the Fed would necessarily respond to tariffs with policy. So before we even get to policy, what's the latest on tariffs?
The news on tariffs continues to change, maybe not quite day by day now at this point, but there's definitely intra-week moves. I think the big news here this week is and maybe 2 points. One, I would say that the deal, and I'll use that term slightly loosely, the deal that the U.S. and the U.K. appears to have put together on paper, and it hits a few points. I want to give credit where credit is due. It looks like there is a broad scope for a deal. It's much more than an MOU, a memorandum of understanding, which was kind of my concern in terms of what the administration might say was a done deal. This seems to be much more broad than that, and that got the market a little bit. The market was pleased in terms of just general risk appetite on the back of that. And then you've had some headlines here. We're recording late Thursday afternoon, Thursday the 8th of May. Some discussion ahead of a big U.S. China meeting this weekend around potentially not necessarily a deal, but potentially a significant cut in the 145% tariffs on China to maybe 50 or 60% at some point next week. Now, to be fair, that's been floated before. We heard the 50 or 60%, if not last week, then the week before. So that's not new news. And, I always like to remind myself that a 50 or 60% tariff on China, U.S. tariff on China, is still a very, very large number. In kind of the real world, that is probably not quote unquote good news. But regardless, in this market environment where people are concerned about supply chain disruption, empty shelves, stagflation, that news is applauded and somewhat celebrated. So we'll see what we get. And the market's obviously quite pleased about that from a risk perspective, whether you look at equities, fixed income, dollar, credit spreads. That's how I would look at it. But in terms of, where are we here? We really only have one deal, let's say. There are many, many deals to happen. We have a 90-day pause, as I'm sure everybody knows, from early April to early July. And I think it will be challenging for this administration to sign a number of deals before early July. So, what is likely to happen is probably another kick the can down the road. Maybe it's 90 days, maybe it's slightly more, slightly less. But it will be very, very difficult to get the big deals done. And the big four I look at, and maybe obvious to everybody listening, would be Canada, Max, EU, and of course, China. I think Japan and India are also important and interesting, and the UK is also important and interesting, but they're probably on a B list for me. The big four, I think, are important, and I think Prime Minister Carney probably set Canada up pretty well with Trump in the administration when he was at the White House earlier this week to at least continue that dialogue in a very positive fashion, which I also think is obviously a very for our listeners sitting here in Canada, that's obviously a very important development.
Excellent, Dustin. You've already given me the material for my next two questions. The first one, you made reference to the 90-day pause on tariffs. Could you run us through how markets have traded from early April through where we are now, approaching the middle of May?
Sure. In the equity market, just take S&P for just as a benchmark. S&P has retraced all, and I think and then some. Haven't been on screens most of this afternoon, but I believe the S&P has now retraced the entire fallout from April 2nd, Liberation Day, which is quite stunning. The dollar is in the process of maybe climbing back, of US dollars in the process of climbing back some of its losses, although that's kind of an interesting story into in and of itself. Credit market is not quite back to where it was, whether you look at high yield or investment grade from April the 2nd. And the bond market is also quite tricky. It's been a bit rangy after having kind of the blow off in yields, going with 10-year yields moving up to the 490 neighborhood in tens, and coming back. I mean, somewhat interestingly here, the market is trading fixed income with the strong data and this relatively positive tariff news as fixed income negative, so prices lower, yields higher, and that's quite interesting because that goes kind of against the a little bit against the inflation narrative and kind of goes back to what I was saying before about the growth narrative. So it has been a bit of a round trip, particularly I would say in equities. The dollar story is interesting. I think the U.S. dollar story is one of these things where, again, I'm sure everybody knows, but you had this period in time in the early April where you had a massive breakdown in cross asset correlation. You had U.S. equities lower. You had fixed income selling off, so prices lower, yields higher, and you had the dollar, U.S. dollar, also lower at the same time. And that, I think, got a lot of people concerned about cross asset correlation, U.S. as a safe haven, and those sorts of things. And I think that the dollar story is very interesting within that set. And I think you're going to see large global institutional players like sovereign wealth funds, central banks, and maybe large pension funds globally start to hedge more of their US dollar risk because they can't necessarily believe or bet on when things go badly that the dollar will naturally be bid and that US treasuries will naturally be bid, prices higher, yields lower. And that I think is a very, very important thing. So I think that hedging story is going to be there for a while. But since early April, we've had a bit of the round trip in equities. I think is probably of most interest to our listeners here, and that is definitely something that people are going to be watching here as we work through the rest of the quarter into early July.
Great perspective, Dustin. You also made reference to Prime Minister Carney's visit to Washington. I'm curious, how do you think that visit to the White House went?
I thought it was good. I thought it went quite well. It was clearly not Zelensky moment, as as a lot of people say. It seemed very constructive, and I think Trump really respects Prime Minister Carney, his background, his ability, what he's able to do, and I think Prime Minister Carney, somewhat equally respects President Trump and understands what he's trying to do in terms of various levers for reshaping the U.S. economy and particularly the U.S. Manufacturing space. So the meeting to me seemed quite constructive. The press conference, although Trump spoke for most of it, it seemed to be one of these things that didn't turn into a yelling fight and something that went off the rails. And I think it's a very, very good start for these two leaders, for Trump and Carney, to continue the dialogue going forward. I'm not necessarily saying that we're going to see a trade deal happen anytime soon. And I think that a rehash of USMCA is very likely to be part of that discussion, and that is complex and tedious. But clearly, that meeting could have gone a lot worse, and I think it's a very good start. So pleased for both leaders that I think we can have a good dialogue here. At least we have the foundation for what I think will be a good dialogue here in the coming months as we try to work through some of these separate issues that are important to both countries.
Very good. Now that speaks to the relationship between the two administrations. I'm just curious, what is the outcome of this meeting and what you're seeing in the early days of Prime Minister Carney's run after the results of the election? What does it mean for Canada? Lots of attention and focus in Canada on what the plan for the future growth profile will be.
No, for sure. It's a great question. Prime Minister Carney, or at least the Liberal Party, put forward a pretty spendy, at least at first glance, platform. And a platform is not necessarily a budget. The budget needs to be further approved and get through Parliament, as we all know. And that budget was not, or at least that platform budget was not dynamically scored, which basically means like we are not going to take the revenues that we think we are going to get from making these investments by spending this money, making investments and getting revenues. We're not going to include those revenues. So when you see that $62 billion deficit for the current fiscal year, fiscal 25-26, it's not quote unquote dynamically scored. And so I think the market is kind of wrestling with that a bit. Like, do you believe what numbers would you assign to that? What numbers would you not assign to that? What's reasonable? What's not reasonable? The bond market is, I mean, clearly given what happened in early April around the US Treasury market, bond market is in a bit of a fragile state here. And it is not that long ago for, I think, any market participant, but particularly for the bond market, from the UK experience in late 2022 when we had kind of the Liz Truss moment. And, I think countries that are seen to be overspending from a fiscal perspective, their bond market is at risk of being punished, for lack of a better term. And I think that is a risk. Now, clearly, Prime Minister Carney is as well suited to understand exactly what I just said as much as anybody else, as any leader or finance minister or central banker globally. So he gets it. So I think that, is he going to really push it? Probably not. But I am conscious that if we do see a fiscal spend from Canada, that the bond market could be concerned around that, and some of the ratings agencies could also be a little bit skittish around that too. Not necessarily downgrading Canada right away, but maybe putting Canada on negative watch. And again, with this bond market kind of this fragile right now, those types of things make me kind of more nervous in this environment than maybe a more normal kind of cyclical environment that we're used to having. Not always, but for most of the time during investment cycles.
That's great, Dustin. I just have one follow-up question on that before I move to my final question to close out our conversation, and that is, you made reference to the bond market reacting to, say, the fiscal situation of Canada and the next budget. Just given where, say, deficit spending is or where debt to GDP is in Canada specifically, do you feel it's already at alarming levels, or would it be the trajectory moving to levels that the market would be uncomfortable with?
That's a good question. I think if we're around 2%, 2.5% kind of debt to GDP on an annual basis, probably about the pain point where I think the market would tolerate it. And we'll see where we're at from a market tolerance perspective if and when the budget is released and what it is. Anything kind of beyond, I think, 2.5% of GDP, that's when I think you have the risk of the market saying, "Hey, hang on a sec, this is going to be a little bit too much." And I'm aware that in the U.S. that number is quite a bit larger, but the U.S. is the U.S. and it's a slightly different. It's a slightly different story. And then Canada is a small open market economy, and I think that the bond market would have a lower threshold in terms of having concerns around sovereign bond market in Canada and what yields could do, and risks of a downgrade, of course. I mean, Canada still holds AAA rating, and losing that AAA rating would be significant. I mean, obviously, it's not awful going to say a AA plus by one or two rating agencies, but losing a AAA status in this market, that's when you have, I think, the risk of, I think to your question, the risk of the market kind of running away a little bit. And then, of course, we'll see what the budget is later this year and what the run rate is. But if the deficit numbers look to be pretty significant for the out years, that is going to continue to be a problem for this government and the bond markets. But again, Carney is so very, very aware of all of these things. I tend to doubt that he's going to make that kind of tactical error. But again, anything is possible, and we'll see obviously how the world evolves into the fall with global growth, inflation, what the fiscal spend is, and that sort of thing. But we are a little bit concerned about the long end of Canada if some of these things happen, and that's one of the reasons why we continue to generally like, at least from a spread perspective, long end of U.S. over the long end of Canada from a fixed income perspective.
That's very insightful, Dustin, and thank you for taking the time to walk us through that. It's really helpful. My final question for you is we've talked about the macro, we've talked about politics, to the Fed, what's going on in Canada, tariffs, and I'm just curious, what should all of this mean for an investment portfolio?
I think it depends obviously on the amount of risk that you're comfortable taking in this environment. I mean, continue to believe, and we'll see how the trade deals come together here and what happens with the China story, because that's a big part of the puzzle, obviously. But our view since kind of Q2 of 24 was that cross asset volatility was going to rise into the second half of 24, based on a few things, and then kind of going into late 24 that if Trump won, that cross asset volatility isn't necessarily going to get faded. It would probably still be around. And here we are, obviously, and I didn't necessarily expect 145% on Chinese goods for early April, although we were concerned about April. But the idea around cross asset volatility and elevated levels of cross asset volatility being around, I think, is very much part of our core thesis. So I think, where are we here early May? I mean, if we get a couple of good trade deals here, particularly with some of the big four, I think we can see cross asset volatility coming off a bit. But until that happens, I think the risk is that we can see those volatility levels stay high. So that broadly means that, risk assets, are a little bit touch and go here, I think, for a bit. Although again, the market is thrilled, I think, on anything that suggests that the loss of U.S. exceptionalism has been too early to call. So you're going to see that. You're going to see the market continue to buy risk. So it is a challenging time for investors. I think for a lot of investors, it's important to stay well balanced. It's important to watch kind of your overall volatility levels, and it's important to stay not only invested, but it's also important to stay invested, with active managers that are watching these situations and having solid medium and long term convictions within our portfolio. Again, we've talked about on a few of these podcasts, but the U.S. Canada spread, both at the long end as well as tens, is probably still our favorite macro trade. We still think that U.S. and Canadian spreads can converge, not necessarily to zero per se, but when the 30s were minus 155 basis points, it was a third standard deviation move, and unless something really odd is happening, we're generally pretty happy to fade third standard deviation moves. It's generally works out as a reasonable trade. We've been selling US dollars against a few currencies, particularly Canadian dollar and Japanese yen here for the last little bit, on options, although some of those have been closed out. We continue to be very, very particular around our credit allocation. Clearly, quality, both in our IG and our high yield portfolios. We aren't really ready to take a ton of risk yet within credit, and we're sticking a little bit more to the quality side. And I would say on the emerging market side, maybe the last one for me, we've added a little bit of Mexico, and we've added a little bit of Brazil here just to pick up some extra yield, as those yields have kind of moved quite a bit higher. But at least on the Mexico side, the bank, Mexico, continues to cut rates, although BCB, the Brazilian central bank, is still hiking rates. But we think that the carry in Brazil can override anything on the asset price. The carry looks so attractive. So we're dipping our toe. In addition to Indonesia, we have now some Brazil and some X, which we've been in and out of course, a couple times in the last 2 years. But we're back into that again. And if the Fed does cut rates later this year, then I think that's pretty constructive for emerging markets, particularly at these levels, if you can deal with the kind of idiosyncratic risk, depending on which market or which country you're talking about. So those are some of the trades that we have on in the portfolio and some of the risks that we're comfortable taking at this point.
That is fantastic, Dustin. Thank you so much for going into that specific detail. Dustin, we've reached time. I really enjoyed our conversation.
You too.
I'm just filling in for Matt. I know you're going to continue your conversation with him next time around, but it's been a real pleasure for me to join you today. Thanks again.
Yeah, same here. Great to do this one with you.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.